Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
Hopefully it stays working. Okay, quiet down. Don't worry, Instagram will wait. It's going to be there in 2 hours. Or Facebook or whatever it is. So today is quite a good topic. Reason why it's good is it shouldn't be new. So it should be a little bit of new stuff, but mostly revision from advanced corporate finance. I know it's not exactly something you took this semester or maybe not even last semester as a course, but you'll recognize quite a few topics that we'll discuss today. Ooh, works. How does this do? Close enough, whatever. So let's get started on cost of capital. So cost of capital, as the name implies, is the cost associated with the cash flows. So in other words, it's the rate that we need to estimate as analysts that we will use to discount the free cash flows to time zero to value the company. In your KGW model, let's open it up here. What do we got? KGW. In your KGW model here, you have the entire tab called WACC, the weighted average cost of capital. Looks something like this. It's a little empty. But what you'll need to do is you'll need to populate. You'll need to enter some numbers here for for JB Hi-Fi, whatever company you're valuing. Risk-free rate. Let's say 3%. Beta. I don't know. Let's say 1.1. Keep that at 5. No tax benefit of debt. And let's say the company is financed 40% through equity. Just a rough example. This is not for JB Hi-Fi. Then we've got cost of debt. Let's say 6%, oh, too high, 5% these days. There's a tax deduction for debt because interest expense is paid before taxes are paid. And so the tax benefit of debt, the easiest way, it's not a requirement, but the easiest way for you to account of the fact that dividends are paid from after tax and interest is paid before tax is to have the interest benefit, the tax benefit, the tax shield of debt, if you like, in the WACC calculation. That's the easiest. Alternative is you calculate the cash flow discount. You'll get the same thing. You'll spend 20 times longer doing it. So that's what analysts do. They have plenty of work to do, and so do you. You've got 3 other courses. So my advice to you is just to include the tax discount, if you like, of having debt in the WACC calculation. And let's say the company's financed, 50% through debt, and the last 10% is, let's say, leases, right? So these other claims could be capitalized operating leases. And let's say the rate is, what did I tell you, 7% or something like that. There is a tax benefit of those as well, because any rent payment or lease payments are paid before taxes. So the company is 100% financed, and your WACC is 5.64 in this abstract example. The numbers I just made up. And this 5.64% goes into the forecast drivers tab down here. Down here, as you can see. In row 223. And that's what's used, that's what the model uses, KGW, to discount all the cash flows, 5.6%. You can have a changing WACC. Some analysts do, some don't. It makes sense. It's better to have a changing WACC. We're not going to do that in this course. There's no rule that says the WACC has to be the same for all these forecasted years. It makes sense that it will go up, in Australia at least, because our interest expense is quite low. Interest rates are very low in Australia right now. They will not go lower. They will only go higher. And then you as an analyst get to predict, when will they go up and how quickly. And depending on that, this will go up. But we're not going to do that in this course. We're going to have a constant WACC, but in reality, there's no rule that says that you have to have the same WACC for each year, right? Realistically, you should have an increasing WACC because interest rates in Australia and all over the world are artificially low. right? They're way too low. The money is way too cheap. It's very easy to borrow. If I can get a loan for 3.87%, that was the loan on my mortgage, a company can get 3%. 3% interest per year. That's so cheap. That's nothing. It should be double that. All right? And historically, interest rates were much higher. And in my opinion, they should be higher, because if you have cheap money, you have bubbles being created, asset bubbles. People start buying houses. Who needs 8 houses? It's nice to have 8 houses, but it creates a bubble, right? It creates artificially increase. When money is cheap and interest rates are low, it artificially increases asset prices, like the price of a house. The houses in Sydney, Melbourne, those prices do not make sense. Right? The prices are here, and value is here. You should not be buying, right? But people are buying. Okay? And they're idiots. Right? Let them buy. It's their choice. It's free. I cannot tell people what to do with their money. Do whatever you like. But to buy something that's overpriced is stupid. Yeah, it is. That's what it is. So, but I'm not in charge. It would be a good world if I was in charge, right? I would be a good dictator. Yeah. I would be a very nice dictator. I would force everybody to learn valuation, right? then there would be a rebellion, right? They would all execute me. I don't want to learn about WACC. So, yeah, that's not going to happen. But so the idea of having a constant WACC is not. If I was an analyst again, wherever in Sydney, back in Sydney, I would have a changing WACC with a growth. But not going to do that in this course. Just estimate one WACC for all the cash flows. But if you want, you can. Up to you. But this is good enough. Yeah. Same marks as if you have a change. Yep.
Could you adjust the Excel to larger scale?
Sure. Yep. So it's in line 223 in your forecast drivers where WACC is entered. So the calculation that you make here in this WACC tab, all these inputs that we'll learn how to calculate or find today, they are used to calculate an overall WACC number here, and this number goes into row 223 to discount all the cash flows, right? So that suddenly this is not zero anymore. These are the discount factors. This is the denominator, if you like. Free cash flow numerator divided by the denominator, right? So 1 over that is the denominator. So each cash flow is multiplied. So let's say the cash flow was next year was 100. Yeah, sure. I can't do that because this is locked. It's transposed, so I would have to delete the whole thing. But let's do it this way. Is it F7 or F9? F7, I think. Let's go to free cash. That's F7 spell check. Is it F? Too many Fs. It's down here. Let's do it this way. So free cash flows go to results 276. Let's go to 276. 276 is here. See the free cash flows. And let's say the free cash flow for 2019 was 100. That 100 would then go here, discounted. This is 1 year from today. Discounted, this is the present value. So with the WACC, now all these discount factors are correct. Well, they're not correct because I just made up the numbers, but you know what I mean. The discounting now works. Yeah. Yeah. So that's where the WACC is used. It's without WACC, if you have blank, as we can do that if you want. You can have all these blanks. Your WACC is 0, and your discounting is 0 as well. It's just everything's divided by 1. That's incorrect. Right? That means all your cash flows in the future are already present value, which is obviously an error. Right. So you need a WACC, of course you do, to discount all the cash flows to time value of 0. Yeah. So that's what we'll talk about today. That's the agenda. Okay, so in order to estimate WACC, we need a little bit of theory, not much. Mostly it's demonstration. We'll be using a few models. We'll use the CAPM to estimate the required rate of return on equity. So the capital asset pricing model by Sharpe and Lintner, model from the 70s, they got a Nobel Prize for it. Is something you've probably seen before already, so we'll use that. When you use that, you have to find the risk-free rate, you have to find the ERP, you have to find the beta, so I'll show you that all today. And then I'll talk about the cost of debt, I'll talk about the capital structure and probably don't have time to talk about the leases. We'll talk about the leases probably in the workshop, see how we go. Yeah, so first of all, what is the cost of capital? A little bit of revision. Right? It's the required rate of return that the two providers of external capital require. There are two providers of external capital, only two, debt and equity. And I mean, convertible bonds are both the debt and equity in terms of characteristics, so it can be a mix of the two, but only all the outside money, the investor money, comes by the company borrowing or selling its shares. Yeah. There's one internal source of cash for companies, and that's retained earnings, right? So generally, not all money that the company generates is paid out in dividend. Usually, some money is retained and reinvested to grow the business. Right? So there are actually three sources of capital, but only two of them are external. The internal one, if you like, is free. There's no such thing as free, but you don't have to pay an interest on it. You don't have to pay dividends. You don't have to pay an interest expense. The retained earnings, if you like, are free is the wrong word. They don't attract a specific cost, a specific rate, like a cost of debt or a cost of equity. Right? So that's what cost of capital is. It's just the required rate of return that external providers of capital require. Right? The investors don't give you money for nothing. They expect a return. They don't give you the money. They don't buy your shares or borrow or lend you money to get nothing in return. They expect a return on their investment, and the cost of capital captures that cost in percentage terms. It's a percentage figure. It's not a dollar figure. Right? Another sort of role it has, it's the required rate of return, but it's also, for us as analysts, we need that rate to discount all the cash flows to times zero, as I showed you. And what's nice about it is it's directly comparable to ROIC. That's very useful for us. Right? If the ROIC, the return, is bigger than the WACC, the cost, return is bigger than the cost, the company is making money. In other words, it is investing in positive NPV projects. So that's the relationship. You've seen that in your introductory finance. If the project is NPV bigger than zero, you invest because you create value. Same thing with when you have the ROIC and the WACC. If you have ROIC bigger than the WACC, the company is making money. And I showed you that last week with bare bones, the very basic discounted cash flow model. This one. Remember, if you have ROIC, so here ROIC is 11 or 10.8%. WACC is 10%, as you can see here. If you start increasing growth, so currently it's 5%, look what happens to the value here. It goes up. Right? That's what you want. So in other words, I'm investing in positive NPV projects by having ROIC bigger than WACC and increasing growth, pumping up the growth in my company. Whoops. I am increasing the value of the company. As you can see, the enterprise value is going up. But, as I showed you last week, when my ROIC is less than my WACC, if I start increasing my growth, this is why growth is useless as a number by itself. If I start increasing growth, look what happens to the value. It starts going down, which means, in other words, I'm increasing in size as a company, but I'm actually increasing in size by investing in negative NPV projects. So when I invest in projects, I still grow my asset on my balance sheet, but I'm destroying money. I'm getting a negative return. I invest, I buy $100 million worth of assets. The project finishes in year, 2 year, 5 years time. That 100 million only depreciates a little bit, sure, but also destroys money by creating a loss for the company. So this is why size doesn't matter. When you're a company, just because you're a big company doesn't mean you're a good company. Okay? It does not matter. Bigger company has benefits, economies of scale and scope, that's true. Something you've probably heard in economics. Economies of scale and scope means that you can spread your costs in you generally do things cheaper. But if you have a shit product, it doesn't matter how big you are. Look at the auto industry in the US. Right? Ford, GM, two of the world's largest car manufacturing companies in the world, they were bankrupt. They were the world's largest companies. Toyota was a much better company that was smaller. Right? Tesla, tiny company. Tiny, tiny, tiny company. All right? Size does not matter. Your products and your services is what matters, because that generates money. Right? Size does not guarantee success, does not guarantee money. It helps, but it does not guarantee it. Yeah? And if you have a bad product, like GM, Ford, Enron was a huge company, bankrupt. Tyco, Global Crossings, WorldCom, all huge companies. HIH, OneTel here in Australia, massive companies, all went bankrupt. They had a bad product, bad management. Right? Size does not by itself matter. Yeah? I would much rather, as an investor, invest in a small company that is efficient as opposed to a bigger company that is less efficient. Yeah? Quality, not quantity. It's always the quality that wins. In the struggle that we have, not just in finance, all over the world, is it more or is it more quality? It's always the quality that wins, always. Yeah? It's not the size. Yeah? So having a WACC allows us to do this ROIC-WACC comparison. If that ROIC minus WACC is positive, if you like, you can take the WACC to the left-hand side. If ROIC minus WACC, so this goes to the left-hand side, is greater than 0, then I have access to positive, I'm investing as a company in positive NPV projects. Yeah. So what cost of capital do we use? There are different types. I'll talk about a few different ones next week in like slide 2, slide 3. But WACC is the one that's most common, by far, is the most common. And when we use a discounted cash flow approach, the discount rate is the WACC. There's an alternative to using a DCF. There's a few alternatives, actually, that we won't use in this class, but they do exist, other methods, still based on discounting cash flows, but the rate at which you discount cash flows is not WACC. It's something else. It's related, but something different. But in a discounted cash flow model or a method or whatever you use to value a company, if it's a discounted cash flow approach, we discount those cash flows at the weighted average cost of capital. Yeah? And as it says there, it's not a requirement. I'll talk about that next week in first couple of slides in next week's lecture. You don't have to have the tax shield in the WACC. It's not a requirement. It saves you a lot of time and a lot of energy if you do have it, right? Most analysts, including myself, always put it in the WACC, the discount that interest expense has, right? Because interest expense is paid before taxes are calculated. Dividends are paid after taxes are calculated. Yeah. So that's the big difference. So the two providers of capital, bondholders get their interest before tax. So the more debt you have, the higher interest expense, the less taxes you pay. So theoretically, you want to maximize the level of debt you have, right? That's correct. The problem with that is when you have debt, you sign a contract to pay back at a fixed rate. So if you as a company have a bad year and you cannot meet that contract, you cannot make your interest payments, you go bankrupt, right? So that's why it's a balance between all companies want to maximize the level of debt on their balance sheet, but if you get too much debt and you have a bad year, you cannot make your interest payments and you go bankrupt, right? So you cannot be 100% debt financed, if you like, because not all years are going to be good years. There's no company in the world that exists, not a single company that always has a good year in terms of performance and profit, right? Always there's a downturn, always. Or even if it's a company that is not exposed to the economic cycle, it will have competitors. And even if it has a patent, let's say you're a company, pharmaceutical company, you cure cancer, congratulations, and you get a patent to protect you from competition for 20 years, it's not infinite. It's only a 20-year monopoly that you have. After 20 years, you competitors step in, and if you're not efficient, put you out of business. Right? So that's the problem with debt. You sign a contract. With equity, you don't have to pay dividends. If you sell your shares as a company and you have a bad year, you can cut your dividend to 0. There is no rule, nothing, no contract that you signed as a company that says you have to pay dividends. That is incorrect. You don't have to. So when you have a good year, right, yeah, you can pay dividends and everybody's happy. and you have to pay your interest. When you have a bad year, you still have to pay interest, and you can cut your dividends all the way to zero. As long as you can pay the debt, you don't go bankrupt. So the calculation, like all things in this course, the calculation is not complicated. It's quite straightforward, right? It's just multiplying a few numbers, right? So the weighted average cost of capital, as you can see on your slide, I'll make it a little bigger, is just two terms, if you like, the equity and the debt, because there are only two sources of external capital. The equity, we need a cost of debt, some kind of a rate, multiplied by how much equity we have. So cost of debt, let's say, I don't know, 5, 6%, multiplied by the company is, let's say, 50-50, financed by debt, 50% debt, 50% equity. This would be 50. 50 plus 50 is 100, so this is half at 7%, plus D50, 50 plus 50, half, let's say cost of debt is 4%, 1 minus 30% is 70%, so 4% times 0.7, so 0.04 times 0.7 times 0.5 will give you the cost of debt after tax. Right? No tax benefit because, again, dividends are paid after tax. Interest is paid before tax. Right? So there's a benefit. That's why it's 1 minus T. Right? So cost of equity, cost of debt, tax rate is the corporate tax rate. Different in many countries. In Australia, it's 30%. It's actually being debated today, I think, in the parliament, whether or not that is going to be decreased. Hopefully it won't be. And it looks like it will stay at 30%, right? Which is good. And the D and E are the value of debt, value of equity. Always we want market values. For equity, that's easy. One benefit of valuing a public company, you can look up the price of the shares very easily. It takes 5 seconds. So you can calculate all the number of shares times the share price, give you the value, the market value of the equity. With debt, it's harder because most of debt, including JB Hi-Fi's debt, is not bonds. They actually went into a bank and borrowed money. So it's not market, there are no market values for that debt. It's a private contract. So usually what happens there, analysts just take the book value. Good enough. Right? And debt, look, debt doesn't fluctuate that much. If it's a financial crisis, sure, it fluctuates. And if interest rates fluctuate as well, the difference between market value of debt and book value of debt can be large. But JB Hi-Fi's case, not really. Right? And it operates in a stable country. Right? And so we'll be using the book value of debt because if a company had bonds, in this course we valued one company that had bonds. So all its debt was listed, if you like, traded like stocks. Bonds were traded like stocks. Not as liquid, not traded as frequently, maybe once every couple of weeks. There was a trade, buying and selling of these bonds, and that was Coca-Cola. Coca-Cola, the Australian Coca-Cola, ASX code CCL, Coca-Cola Amatil, was the company that we valued in this course. It was the only company we valued in this course that had bonds that were listed, so we can look up the market price, CCL. Okay company, nothing, not really that okay. It's nothing fascinating about the company, right? I mean, they sell sugar water. It's not like they're trying to cure cancer. They probably give cancer, right? Their products, right? It's like a cigarette company, right? So it's not fascinating, but that's the only company that we ever valued in this course that had, you could actually look up the market value of the debt. And the reason for that is obvious. Australia is a small country. Companies are smaller, right? We're about 1/10 of the size of the US, 1/10, so 1/10. So in the US, a lot of companies have bonds that are listed. So you can go in the exchange, go on the New York Stock Exchange website, like this, like the ASX website, and look up the bond price. And just calculate the number of bonds times the current bond price will give you the market value. Can't do that in Australia. Most companies get their debt like I get my debt. I walk into a bank and negotiate a contract and sign a contract. And that is never released. That's private information. So we never know what the market value is. There is no market for it. When the bank holds the mortgage or the loan until it matures in 10 years or 5 years' time, there is no market for it. It doesn't sell the bond on. So there's no market to get the market value, in other words. It just holds it on its balance sheet until the loan expires in 5, 10, 15, 20, 30 years' time, whatever the contract says. So all we can do as analysts is we cannot guess. All we can do is just take the book value, which is recent as at the 30th of June, the end of June, or end of December, because the company also reports half-year results at the end of December. Right? So that's all we can do. But for our purposes, for this course in this semester, the 2018 report, which to my knowledge was released today, finally. Where is it? It's here somewhere. 16th. Oh, no, wrong company. We're not valuing Coca-Cola anymore. We're valuing JB Hi-Fi. Right. So, voila. Yeah, 13th, that's today. And it was released right there, 2018. Yeah, this morning. So now you can populate in KGW the 2018 and 2017 numbers, yeah, from that report. So more on that in the workshop. Yeah. So the calculation is not complicated. As you can see, it's here. There's an example. It's just multiplying a few numbers. It's not complicated at all. Let's say this company was 91.7% financed through equity or shares. 8.3% of the company was financed through borrowing or debt. Cost of capital for debt, 4.7, 9.9 for equity. This tax rate in this example is 38.2. So 38.1 minus 38.2 multiplied by 4.7 gives you 2.9. 2.9 multiplied by 0.083 will give you the contribution of the WACC of 0.2. And 10%, 9.9% multiplied by 91.7% will give you a contribution to the WACC of 9.1. So total WACC is 9.3, just the sum of the two sources of external capital. The calculation is just multiplying numbers. That's not hard. What's hard as analysts is coming up with these numbers. Where do these numbers come from? How are they calculated? Right? That is hard, because so far in your other finance courses, if you ever use the WACC, let's say in corporate finance, I think you've seen this equation before, you were given all the numbers, right? You were always given the numbers, and you just multiplied them. Multiplying is easy, right? That's no problem. But when you are an analyst, nobody tells you use this for the cost of debt, use this for the cost of equity, use this for the tax rate. You have to look all that up. You have to find that out on your own as an analyst. That's your job. That's what you're paid for. Right? So that's what we'll talk about today. So I have one slide of theory, so not too bad, right? A little bit of theory, just one slide. So some mistakes you can make. These are obvious, but still I would like to tell you these because this is one area where you can get overconfident. Oh, WACC is easy, you're just multiplying numbers. But you still, just because it's easy doesn't mean you should be quick or ignore basic rules, right? So first of all, you need consistency between the free cash flows in the numerator and the WACC in the denominator. Remember, the reason why you're estimating WACC is not because I'm asking you to. You're doing that as analysts because you need to discount the free cash flows. So there has to be consistency between the cash flows that you're discounting and the percentage rate that you're using to discount those cash flows. The tax shield of debt must be either in the free cash flow as a dollar figure or in the WACC as a percentage. It cannot be in both, otherwise you would be double counting. In this course, and in fact in reality, it's always easier to have it in the WACC because it's just 1 minus t in the WACC equation. And it's a lot quicker just to do it. But there's no rule. There's no rule that you have to do that. You can have it as a dollar term, as a discount, and you have it in the free cash flow determination. So in this course, we have free cash flow is no plat. What's in free cash flow? It's no plat. It's capex, depreciation, and what do we got? So we got depreciation, blank. So going back to lecture 1, what did I tell you? Did I tell you that? I probably didn't tell you that. Load, there you go. So what did I tell you? Yeah, I told you that. So remember in the first lecture I told you it's no plat, it's depreciation on any non-cash item, it's capex, which is just capital expenditure, and the fourth term is working capital. You can have a fifth term, which is the interest component, the interest tax shield of debt. I've seen analysts do that, but it's easier not to do that, just to have this and have the tax benefit in the WACC equation. So let's do that in this course. So you can't have it in both, you can only have it in one, and I recommend you put it in the WACC. Next, the currency denomination of the free cash flows, the numerator, and the interest rate, the denominator that you discount the free cash flows, have to be identical. By that I mean, JB Hi-Fi is an Australian company. Its cash flows are going to be in Australian dollars. Yes, a little bit in New Zealand dollars, but very small amount. And plus all the annual statements you're using, if there's, on the income statement, if there is any income in New Zealand dollars, the company translates that into Australian dollars anyway. It has to produce consolidated annual statements. So it does the conversion of New Zealand income from those stores in New Zealand into Australian dollars for you. So everything is in Aussie dollars. Well, if the cash flows are in Aussie dollars, the capex, the depreciation, the NOPLAT, then all the WACC inputs, cost of debt, cost of equity, everything has to be Australian dollars, the Australian tax rate, Australian risk-free rate. Otherwise, there is no consistency, and that's a mistake. Next, this is a common mistake. I hate this one. Nominal versus real. Most of the time, analysts forecast their cash flows in nominal terms because inflation is one of the drivers. For us, I talked about this last week, it's the growth in households, but that's really inflation, that's really population growth. Right? So if you have that as a key core growth factor or value driver, if you like, in your cash flows for sales, for predicting sales in JB Hi-Fi, then you're doing your prediction in nominal terms, by the way, which means the cost of equity, RE, the cost of debt in this equation all has to be also in nominal terms. In other words, it has to include the inflation, right? Because if your cash flows include inflation, all these percentages, all these RE, cost of equity, cost of debt, has to include the inflation as well. So everything has to be nominal. There's no rule against that. You can have everything in real terms, but then your free cash flows, inflation has to be subtracted from any growth. Yeah. Another rule is you want to use market weights for everything here, the E and the D. As I said, the E is easy. I'll show you that. I give you the data for this part of the assignment. I'll talk about that in a minute. Cost of debt, again, you want market value. In Australia, you'll almost never get it. Almost never. This capital market, the debt and equity capital market, is just too small. It's expensive to write bonds and sell them on the exchange. It's a lot cheaper to walk into a bank and negotiate a contract. It's a lot cheaper. It's not cheap to sell bonds. It's expensive. The benefit is, yes, the downside is it's expensive. The benefit is, especially in the US, is you have more people to lend you money, right? So when you want $100 million, walk into a bank. When you want $100 billion, write bonds, right? Because the bond market is much larger than what you can negotiate with a bank. Yeah, so when you're a large US company, you're Halliburton, you're ExxonMobil, you're Apple, one of these companies, they're just massive, huge companies. $100 million loan is nothing to you. It's nothing. It's a waste of time. You operate in billions, so and generally banks don't want to lend billions and hundreds of billions of dollars, so you have to write bonds. Right? You have access to more borrowers because bank is, if you think about it this way, bank is one borrower. If you want $100 billion, you need to sell your bond, if you like, to a lot of borrowers. Right? Because bank is only one borrower. But if you want 100 million, 10 million, 15 million, these are small numbers for companies, walk into a bank, it's cheaper and quicker. It is. You don't need lawyers, you don't have to audit anything, you don't need bankers to sell the bonds, you don't have to pay them fees, transaction, consultancy fees, all that. Do it yourself, walk into a bank. Yeah. So for debt, we won't have market values, we'll just have book values. Good enough, good enough. Next, for the cost of equity, it's very common, this is standard in the industry, is to use the capital asset pricing model. The model is not good, right? It has a lot of problems. I'll talk about those problems on the next slide. But there's nothing else. The pharma and French model that you've probably seen in investments or maybe other courses does not work. The 3-factor, the 4-factor, the 5-factor pharma and French model, which is just the CAPM with more factors. CAPM has one factor, right? One term. As you can see here, it's one term. The market portfolio, right? It's one term here. The pharma and French 3-factor model just has more terms here. And you think the more the better. No, incorrect. The pharma and French model does not work. It's a lot easier just to keep it simple. Right? So we don't have a good alternative in finance. We're looking, I mean, as academics, we always want a better model, but it's not easy. It's not easy. It's very hard. So the best we have is something crap, but that's all we can. That's all we have, right? So we don't have anything else. So and if you try in the industry, I've seen one analyst try to do something else like a pharma and French model. Everybody just starts attacking it. It's like, why are you using this? Why are you using that? Why are you not using? Why not CAPM? Why? Explain, prove. Solve. I'll kill you if you don't prove this, right? It's like, just use the CAPM so you don't get killed, right? It's basically, poor guy, right? He was trying. He had a good, right idea. He was saying the CAPM sucks. It does. It's a bad model, but when you try to use something else in practice, people just start attacking you. Why are you not using the CAPM? It's pretty sad. Next is, just like with all forecasting, always in valuation, if it doesn't look right, it's not right. Right? If something doesn't look right, if you have a cost of debt of 10%, it's wrong, by the way. Right? If you have a cost of equity of -2%, I've seen students do that, that's incorrect. There's no such thing as negative. Having a negative cost of equity, negative cost of debt means they're paying you for taking their money. That's nice. I like that. I wish I was a company like that. I would borrow as much as I can because for every dollar I get money, right? But it doesn't work like that, right? So the KE and the KD, always positive, please. Always. Always. Right? So. And again, it's subjective. You're forecasting the future. Nobody has a crystal ball. You're just trying to come up with something that fits the story. Just like with forecasting revenue, I was talking about last week, I was talking about the store rollout model and how the company grows organically. Inorganically, they bought good guys, right? It all fits the story. Same with your WACC. Does it make sense? Right? There's no solution because it's a future prediction. It's just a prediction, right? So one team, so we have 50 teams in this group, one team will have a WACC of 6%, the other one 6.5, the other one 5.2, I'm just making up numbers, the other one, 7%. And then which one's correct? They can all be correct, right? It doesn't mean one's correct and all the other ones are incorrect. That's wrong. As long as you don't make a mistake and all the variables you're using are correct, all full marks, right? There's no answer. It's just there's no solution, sorry. It's just it's a triangulation exercise, something that it's an approximation is the right word. Okay, so our task today, can I write like this? So, yes, look at that, right orientation. So our task today is to use this WACC, so debt equals debt plus equity, cost of debt, 1 minus the tax rate, plus equity, debt plus equity, cost of equity. Our task today is to estimate, the calculation is easy, just multiplying numbers like I said, but our task today as analysts is to come up with ways to estimate this, and this. That's what we need. That's our job today. That's our job today. So first one, let's do the easiest one. That's the tax. I don't even need a slide for that. That's 30%. That's the company tax rate. I think I showed you this on the slide. In a previous lecture. If you're valuing a company that's operates in a different country, obviously you have to use the corporate tax rate of that particular country. So KPMG have these global tax rate tables. So if you're valuing a company in America, in Canada, in whatever country, Obviously use the tax rate of that particular country where the company operates in. If it loads, next year. Here we go. So Australia, 30%. Yeah. So for T, please use 30%. In the past, it was 36. We had a reduction, I don't know, in the 80s, I think it was, 36 to 30. Now there's some debate about reducing it to 20, I think 26 or 25, because the Americans reduced their taxes a lot. Yeah, so huge reduction, which is, again, it's a bad idea. They have a huge deficit, but Americans are crazy, let's be honest. Trump is president, right? I mean, they elected an orange president, right? I mean, that's never been done in history of civilization, right? So an orange president who's a moron, right? So there you go. It's crazy. Yeah, but let the Americans do whatever they want. So whatever country you're valuing in, obviously use the tax rate of that. A good question would be what if the company does half the business in the US, let's say, and half the business in Australia? Do I use 30% or do I use whatever they reduced it to 27, right? Americans, 27. Where is it? Yeah, 27. So do I use 30 or do I use 27? It's a good question. It really comes down to two things. Where do they get their money from? Do they borrow from Americans or do they borrow from Australians? That's a key question that you need to answer as an analyst. And then the cash flow. So in practice, usually company borrows from both. So it would have to be a mix, and it would be a weighted average mix of the debt. So what you would probably do in reality is you would expand your WACC. Where's my pen? You would expand your WACC to have a US section, and then you would have another term. For the Australian section. Is that right? That looks right. And this would be Australian. So this would be 27. And all the money that's borrowed in the US and all the shares that are sold in the US at this cost of debt, at their tax rate, at their cost of equity items, and then you would have an Australian Oz part of the WACC equation. That sort of makes sense to me. We don't have to do that with JB Hi-Fi. So you would actually expand your WACC calculation to take account of the fact that they're getting their money from two sources, America and Australia. Yep. Yep.
So when you're calculating that, why don't we use the effective, marginal tax rate?
Yeah, that's a good question. So do you use the marginal? Do you use the effective? Do you use the statutory? Use 30%, which is not the marginal. It's not the effective. It's the statutory tax rate. So there are three types of tax rates that we have, right? We have the company tax rate, also known as the statutory tax rate. It's what's written in the law, 30%. Then you have the marginal tax rate. Marginal tax rate doesn't apply to companies. It applies to individuals. Marginal tax rate is if I earned as a company an additional $1, what tax would I pay? That doesn't apply to companies because companies all their income is taxed at 30%. My income is not taxed at one rate because the money I as an individual make, maybe $20,000 of that is not taxed at all. From $20,000 to $60,000, it's taxed at like 20%. From the $60,000 to $100,000, it's taxed like 35%. And from anything above that is taxed at 45%. So the taxes are different in each bracket. That's called marginal taxation or progressive taxation, if you like. The more you make, the more you get taxed as an individual. There's no marginal tax rates in companies. It's all 30%. And what the lady's asking for those listening is the effective tax rate. The effective tax rate is what the company actually pays. The reason why they don't pay 30% is they might have you be using DTA, deferred tax assets, for example, to reduce their tax rate. They had some losses in the past, like Tesla, for example, huge losses in the past, and they're building up their deferred tax assets very, very large, and then they'll start using that when the company turns into a profitable company, and it starts reducing the deferred tax assets. until it runs out, and then it actually has to start paying taxes. So even when the company makes a profit finally, their effective tax rate will be 0. They won't pay any taxes because they're just using those deferred tax assets, those non-operating assets on their balance sheet to offset, because they get, you don't get paid for losing money, but you get tax credits for losing money that you can use when you start making money as a company in the future. All right? It's a good question. Yeah, taxes are, if you look at the Australian tax code, it's like this thick. I never read it, and I never will. I just look at my taxes, and I do my own taxes. I don't trust anybody, so one benefit is if you don't trust anybody, you have to do, the one downside is you have to do everything yourself, but then you learn how to do it. That's the benefit. So I just do my own taxes, and even for that, I have to read about this much, but for companies, yeah, it's very thick. So, yeah. So it's not easy. Okay, but first part of the tax is easy, right? 30%. Yeah, 30% here in my WACC. So when we go back to the KGW model here, I think I already did that for you. It's already in the WACC tab, it's already 30%. Yep. So you can leave that alone. Okay, now let's do something that's a little bit more complicated. Let's talk about the cost of equity, the KE. Cost of equity is the required rate of return for shares, to shareholders, what shareholders want. Shares are risky assets, which means you don't want the risk-free rate. You want above the risk-free rate as a return. At the very minimum, for whatever thing you invest in, you want at least the risk-free rate, and then you want to be paid for every unit of risk that you are exposed to as an investor. Well, that's the CAPM. Higher risk, higher return. Right? So at the very minimum, you're paid the risk-free rate. And for every unit of risk of that share that you buy, which is captured, the riskiness of any share is captured by the beta, you're given some kind of a compensation, premium, if you like. And with CAPM, it's called the ERP, the equity risk premium. Historically, the ERP is between 5 and 7%. I've seen it as low as 4. I've never seen it less than 4, and I've seen it as high as 8 point something, let's say 8.5. So, but historically, it hovers between 5 and 7%. 6 is sort of like the historical average. If you go back 120 years, if you calculate returns, the premium, if you calculate the returns of shares above government bonds, which is the premium is the premium above the risk-free. That's why it's called a premium. It's the return on stock minus the return on bonds. Historically, it's about 6%. So for every unit of risk, you get 6%. So if you invest in some crazy company trying to, colonize Mars, the beta better be high, like 4, right? 4 or 5. If it's a young growth company, risky, sort of trying to change the world like Tesla, the Tesla beta is not 1 or 1.2. It's more than that. I would expect maybe 1.5, 1.6, something like that. Maybe going down now that the Model 3 car, if you're following Tesla, has really taken off, and the company has increased production, and it's actually breaking even now. The company's breaking even. It's no longer losing money. Right? But for an established company like, Commonwealth Bank, I understand if you're following the news, the banks are not very popular right now, right? The Bank Royal Commission is finding a lot of corruption, but they're established. They're very safe companies, relatively. Their beta would be something like 1, right? Quite standard. So if the beta is 1, ERP 6%, current risk-free rate, let's say 3, 3 plus 6 is 9, you would expect cost of equity to be about 9% for a sort of standard, basic company, sort of average company. About 9, maybe 8%, something like that. Okay. So ERP is the expected return on the market portfolio minus the risk-free rate. Right? That's the ERP. Again, historically around 6%. Around 6%. You've seen this before. Maybe your lecturer before didn't talk about all the problems. Maybe they did. I'll talk about them now. There's a lot of problems with this formula. The capital asset pricing model, invented by Sharpe and Lintner in the 70s, 1970, 1972, something like that. Building, and it's not even their work, to be honest. It's really, they got a Nobel Prize for one definition. The market portfolio they defined is, the risk-free, the benchmark portfolio should be the market portfolio. For that definition, they got a Nobel Prize. How funny is that? You define something because they just ripped off the work from Markowitz. And Markowitz was the revolutionary work, 1952. So the efficient portfolio frontier by Markowitz, I can't spell his name, Markowitz, 1952, was that revolutionary work, right, on the efficient frontier. That was the first version of the CAPM, if you like. So you probably remember this from, I don't know, investments. Well, it doesn't matter. And what Sharpe and Lintner did in the CAPM is they took this idea and said the efficient portfolio is the market portfolio. So the fully diversified portfolio is the equity or the market portfolio. They just defined what the efficient portfolio is. So if you look up the CAPM on whatever Wikipedia's, let's say, was it in the 70s or was it earlier than that? Was it 60s? 60s, sorry. Right, so Sharpe and Lintner took that idea from Markowitz. 72 was the black CAPM, which is a variation of the CAPM. That's why 70s. They took the Markowitz idea and they just defined the market as the efficient portfolio. For that, they got a Nobel Prize. They actually, it's funny. I always told this story in my class. That model was a footnote. They got a Nobel Prize for a footnote. I think it's the only time in the history of the Nobel that the award was awarded for a footnote. Yeah, for 2 sentences. That's it. So as a researcher, I can tell you when I put something in a footnote, it's not designed to be read. It's just for completeness. I don't really care about footnotes. The readers are not supposed to read footnotes. It's just to, for those who want more information. They got a Nobel Prize for it. Oh man, good times, right? So as you can see, the model sucks, and the story is, and they knew it sucks, right? Even in the 60s. And the reason why it sucks is obvious. The model is just this. You would have seen this before in high school. Right? Remember this from high school? Remember that? Yeah, bad stories. That's the CAPM. That is the CAPM. That's all it is. It's a linear equation. Remember this? That's what it is. Right? The slope is m, right? And the intercept is b. Right? That's the CAPM. The slope is the beta. This is the ERP, and this is the risk-free rate. Right? And that's the expected return on the asset. That's all it is. So we do not live in a linear world. Financial returns are not linear. Higher risk, higher return, that's true, but not one for one. The higher risk, higher return, the relationship exists, it's upward sloping, that's true, but it's not linear. We don't know what it is. Yeah. It's not linear, obviously. Right? Higher polynomial something. Researchers are unsure what it actually is. But the model assumes that returns are linear. So higher risk, higher return, one for one, which is too simple. Yep?
Yeah, but it gives you a base to understand.
Can you speak up? Sorry.
It gives you a base to understand.
Correct. So the reason why we use it is, so the question for those listening is, it gives you a foundation, a base. That is absolutely correct. It does that, but it is too simple, and to find out what it is, we know it's not linear, it is upward sloping, but we don't know what that relationship is. So it has to be a higher polynomial relationship, there has to be a lot of more terms, it has to be squared, square root, whatever it is. Different returns are not normally distributed, they're negatively distributed. But like the gentleman said, yeah, it gives you a base, it's just, it doesn't work. The CAPM works 16% of the time. So 16% at a university is a fail. right? Anything below 50% is a fail. So if something works 16% of the time, you shouldn't be happy. It maybe is a good starting point, but the point doesn't matter because we don't have anything better so far. Maybe in the future, sure, but not right now. Yeah. So one problem of the formula is with returns do not follow a linear projection. They do not follow y equals mx plus b. They're upward sloping, but it's not linear. Next, the CAPM assumes that all these inputs, its inputs, the beta, the ERP, the risk-free, are static. They don't change. It's a one-period model. It's incorrect. Risk-free changes every month, sometimes every day. ERP changes. The riskiness of a company changes also. It's dynamic. One company may start, JB Hi-Fi might start as a retail business and then change into something else. It might be a hardware company. So the different industry, different risks. Right? So the beta is not static, the ERP is not static, the risk-free changes as well. The CAPM is a one-period model. Ignores that. It's not a continuous model. Yeah. You can modify it, but it's not continuous. Yep?
It couldn't be like Einstein's theory, but I think like it at least gives you, what do you say? So, because it has a psychological component in it, finance does, like, depends on people. So you can always not predict it correctly, but you can come at least like near to it. Standard errors, you can minimize the standard errors. That's what I mean.
Correct. Yeah. So the gentleman, for those listening, is yes, it doesn't work. That's true, but it's good. It's sort of good enough, and you can use, such as in regression, you can minimize your standard errors to come up with a better slope coefficient or something like that. You can do that again. Sure, no problem. But you cannot tell me that the model assumes all those things are static, and they're not, in real life, they're not static. They do change, they do update. But yeah, sure, there are various ways you can improve the model, and people have tried over many years. Ever since the model was born in the 60s, they knew even then that it was garbage, and they've tried to make it better. But as you can see, we're still here. We're still talking about the CAPM and the basic one-term CAPM. And what the gentleman was asking as well is, the model assumes incorrectly that everybody's the same. And as the gentleman pointed out, that is not true. People are heterogeneous. They're not homogeneous. Right? I care about returns differently to some retiree. If you're a retiree, you probably you care about not losing money today. Right? If you're in a stock market, you probably have a very conservative point of view. You avoid risk. You have a lot of cash, a lot of bonds, something that doesn't lose a lot of money. If you're a young person with a superannuation or a pension account like me that cannot access that money until I'm 70, wow, I think I'll die before then, I have a more risky point of view. I don't mind if the stock market goes up and down over time, right? I only care about that overall it goes up. So I might have a higher risk tolerance for investments. CAPM does not account for that. It cannot differentiate between risk averse, less risk averse. It cannot differentiate between people who care about the next 1 year or the next 2 years or people who care about the next 20 or 30 years, right? So it doesn't allow the flexibility to have varying time horizons. Right? It ignores trading costs and ignores taxation. Trading costs have gone down a lot over time, that's true, but they're still not zero. They're still at least 1%. Yeah, quite standard, maybe 0.5%. Depends how frequently the stock is traded. They can be quite large. And market is not the only risk factor. Right? The model has one risk factor, as you can see, the market portfolio. Right? It nominates a market portfolio. But again, the world is not linear. It may be a good sort of guide. Well, good. I mean, if you consider 16% good, I don't, but there's nothing else. But as I mentioned, we don't have anything better. We don't have anything better. And academics have looked and tried, and we spent 40 years trying to come up with something better. We've all failed. So, okay, and the last thing that sort of matters is the estimation of these inputs, and I think the gentleman sort of touched on this. is not unbiased. How you estimate beta, we'll talk about that in a few slides, is dependent on, there's no rule that says estimate beta like this. You have to make a decision. The CAPM doesn't tell you how to estimate beta. It doesn't. I looked, it doesn't. It doesn't give you a guide on how to estimate beta, what risk-free rate to use. It's a one period, but one period can be 1 year or 5 years or 20 years. It doesn't tell you what period to use, what frequency to use. So therefore, you have to make assumptions. And those assumptions may be incorrect or correct. We don't know. Yeah. So despite all that, let's use it. Right? So let's have a look here. So first, let's start talking about the market definition. So what is the market portfolio? Right? The CAPM requires us to nominate a market portfolio. And that is not always trivial. It sounds like, oh, just use the stock exchange, right? In Australia, the ASX 200. Yeah, quite common, very common benchmark. The market is the ASX 200, right there. Or the ASX All Odds, which is the top 500. 500? I think it's the 500. Right? So that's the market portfolio. But again, the CAPM doesn't tell you what to use. It just says market portfolio. It doesn't tell you what market. Right? So the reason why it's also not a trivial issue is because, yes, JB Hi-Fi is an Australian company, but remember, we're trying to come up with a cost of equity for the investors, from the investor's point of view. We're, as analysts, when we estimate cost of D and cost of E, the cost of equity, cost of debt, we have to look through the eyes of investors. Investors have a global point of view these days. It's not that hard to buy American stocks or Chinese, well, not the A-class shares, for the foreigners. Right? There's different types of shares in China or Hong Kong, and you can't buy, only domestic citizens can buy certain types. Right? But in Europe, you don't have to be a German to buy German stocks in German companies. Right? Because of globalization and digitalization of financial markets, it's not that difficult to me to buy stocks in Apple. I would never do that because I despise the company and all the fees they charge for their products, but I can. It's not that difficult. So when investor has a global point of view, your market portfolio should be global as well. It shouldn't just be sort of like an automatic reaction. I've seen analysts do this. They just get, oh, it's an Australian company, just use the Australian index. And then I would talk to them and say, I see what you're doing, but that's a simple view. Our clients at Credit Suisse, we invested a lot more than in Australian companies. Right? They invested in US companies, they invested in Asian companies, they invested in European companies. So your market definition should also be global. It shouldn't just be Australian ASX 200 index, right? So from a practical perspective, it's very common just to select the market definition of the domestic market, but you should take the investor's perspective. You shouldn't just use, if you're in Australia, ASX 200, or if you're in the US, use the S&P 500, which is their main board index. Right? The S&P 500 is the main US index of 505 of the largest companies in the US. Right? So there's two choices there. So usually, yeah, the natural reaction is to use the local exchange, the ASX 200, but I can show you, a few examples where this is absolutely incorrect. Think about the consistency of currency. Remember, we have to be consistent, like I said on slide 3, that the WACC and the cash flow has to be the same. Well, if it's an Australian company, but most of its business comes from the US, you should not be using the ASX 200, the local exchange market, the stock market, as your market definition. Because even though you're listed and you are domiciled, it's called, you're incorporated in Australia, if you do 80% of your business in the US or somewhere else, you may be an Australian company on paper, that's true, but in reality, you're not an Australian company. Yeah? So your cash flows are not, main cash flows is not in Australian dollars. On the accounting statements maybe, but most of your cash flow is in reality in American dollars or some other currency. Next, the availability of data. Actually, there is a world index we can use. We can actually take the perspective of investors, which is global in the 21st century. We can say, well, there's global equity indices. I'll show you the data in a sec. It's actually quite easy to download that data. I provide it to you. And the last example why you shouldn't just automatically take the local exchange as your benchmark market portfolio is sometimes you have this concentration problem where you have a big company, I call it a big fish, in a very small market. The example there is Nokia, which is now bankrupt, but in the past it used to be the largest company in Finland, and by largest I mean 60%, huge. So the index in Finland I'm using the index of the top 100 Finnish companies. No, you're not. Using the index, it's the top 100 companies, but it's really one company, right? Because all the indices are value weighted, except the Dow, which is price weighted. But all these indices, these stock indices that you can nominate as a market portfolio, let's say the ASX 200, all the All are value weighted, which means the largest companies have more influence. If they go down by 5%, if Commonwealth Bank, Australia, the largest company, goes down by 5%, the index will go down by 4.5% or 4%, right? So in Australia, we have 4 banks and 2 mining companies that actually determine the index movement. So yes, it says 200, so it's the 200 of the largest stocks, but we have a concentrated market. The 4 largest banks, Commonwealth Bank, NAB, ANZ, and whatever the 4th one is, and Rio and BHP are just so large that out of that 200, those 7 companies determine what happens to the index every single day. In other words, there is an ASX 20. If you download the data for the ASX 20 and the ASX 200, you calculate the returns and calculate correlation between the returns of the ASX 20 and the ASX 200, it's going to be very high, 96%. Maybe 94, 96, 95, something like that. They're highly correlated because those 20 companies, if you like, determine those 180 other companies are just too small to have a big impact on the ASX 200. Unless they go, something crazy happens, like they go bankrupt. They go from a $5 billion company to a 0 in one day, right? So what's the index? What can we do? So let's have a look. So for this, for WAC, on your Waddle page, you will find, so on the Waddle page for this week, the chapter that I ask you to read is not very good in the textbook. So Jeff wrote additional notes that are here. So have a read of that. That's sort of like an additional reading because the one chapter in your textbook is kind of crap. So it is. So Jeff wrote additional notes. And so we have a lecture. The lecture example I'll get to in a sec. Here in the assignment data folder on Waddle, you will find data that you need for estimating WAC. When you open that, you will find data for not just the ASX 200, you will also find data for the MSCI World Index, the MSCI, the Morgan Stanley World Index. So I gave you data for 2 market portfolios, and the MSCI World Index is probably the best global market portfolio that I can get data for. Yeah, that goes back a while, goes back quite a long while to the late 60s, and that can be your market portfolio. You can estimate the beta, what I'm about to show you. You can do it for both the ASX 200 as your market portfolio, and you can do it as well for the World Index. You'll probably get something similar, but the more correct is what I'm trying to say. The more correct approach is to use the World Equity Index. Yeah, because investors have a global view. They don't have an Australian view. Yeah. Yeah. I don't have all my money isn't in Australian stocks and bonds. I have international exposure. And I'm just one person, right? I don't have that much money. I'm not even a serious investor, and I have a global point of view. Right? Most people do, right? It's the 21st century. Right. So first step in the estimation of cost of equity and the CAPM is to define a market. The world equity is probably the best market I can think of. The alternative is just to use the ASX 200, which is also okay. Nothing wrong with it. Next, what we need in the CAPM, so let's go back here. So what we're doing now is we're going for, ignore this, what we're doing now is trying to estimate this cost of equity, which is equal to the risk-free rate plus the ERP times the beta. So we know what the market portfolio is now. We can either use the MSCI World or the ASX 200, up to you, whatever you like. Now, what about the risk-free rate? Right. Well, the risk-free rate is not the same as the company's cost of debt. Of course it's not. Just don't get that confused. The risk-free rate is the government risk-free rate. In other words, it's the yield on government bonds. Where do you get that information from? No problem. Reserve Bank, RBA. Go to their website. Go to stats. Go to interest rates. Go to the capital market yields on government bonds, the monthly or the daily rate, whatever you want. Open. The risk-free rate, so we either use the 5-year or the 10-year. We'll get to which one. The current risk-free rate is about 2.64%. And that's a market rate. Government bonds are very liquid. They're traded every day. Every day. In the US, every day. In Australia, I haven't seen the frequency. I think it's every day. So pretty liquid. So those numbers are actually not stale. They're up to date. So 2.64% is what you should use. So in your KGW model, risk-free rate, 2.64%, please. Yep. Now, why the 10-year? So that's a very good question. It's actually subjective. So what duration of the bonds do I use as an analyst, right? Because you have a choice. I mean, there's no rule that says you have to use the 10 or the 5. You can use even the 1. You shouldn't, by the way. Or the 3. You get data on 3. You get data on the 2-year. And as you can see, the risk-free rate is not the same. So which one should you use? That's a good question. Your textbook tells you 10 years. The reason why it does that is because companies do have a long-term view. Most projects that companies invest in is more than a year, more than 2 years. The average project that companies invest in is about 5 years, maybe a little bit more. But the textbook says, well, companies still have a longer view than just 5 or years. So you should use the 10-year is sort of the standard. Again, there's no rule, so if you want to use 5, you can. I won't deduct any marks. The reason why 10 makes more sense to me for JB Hi-Fi is when it opens these stores, it generally doesn't open the stores thinking it's going to be for 5 years and then it's going to close the stores, right? I mean, it can happen, right? It opens the store doesn't do very well, it has to close down the store and probably closes it down within 3 years. But most stores that are open are not closed. Most stores that are open remain open for more than 5 years. So the idea behind JB Hi-Fi spending money, negotiating a contract, opening a new store is that it will operate for 10, 20, 30 years, right? So to me, that makes more sense for JB Hi-Fi's business model. They don't open a store for 5 years. They open it for more than that. So the 10-year also, I agree with the textbook. I mean, every company is different, but for JB Hi-Fi, it makes sense. But it is subjective. Yep?
Wouldn't it be more sensible to use the date or the risk-free rate of the years, which, like, if a company has an average debt period of, like, I have loans for average about 6 years. So wouldn't it be more sensible to use the rate for 5 years or closely the
Excellent question. So for those listening, the gentleman's asking, if the company reports, some companies do this, they report on the average duration of their debt in their annual statement. I think JB Hi-Fi is actually one of those companies that does do that. It's somewhere on page whatever of the annual statement, like what's the average duration of their, or maturity of their debt. Would that make more sense? So if they say it's a 5-year, sort of most of our debt matures in 5 years, then the risk-free rate you should use is 5 years as well. That's an excellent point. It makes sense for the cost of debt, right? But here we're not estimating the reason why you can do that. Nothing wrong with it, by the way. I won't deduct any marks. The reason why I wouldn't do that is because you're talking about the cost of debt. We're not talking about cost of debt here. We're talking about equity. We need a benchmark for equity. Equity holders also have, just like this is what the textbook talks about in the chapter, because we're trying to get a risk-free rate for the cost of equity component of the CAPM, equity holders have longer view than 5 years. They have 10 years, even longer years. So when you're estimating cost of debt, it makes sense what you're suggesting, so correct. But when you were pumping a number into the capital asset pricing model equation, it makes more sense to take a longer view because investors have a longer view and you're trying to get a benchmark rate for the cost of equity, not for the cost of debt. So yes, I think it even says that. Potentially different rates could be used for different periods, but is it worth the trouble? Yeah, so you can use, again, there's no rule that you should use 10 years, but for the equity, I agree with the textbook and sort of taking the longer view because investors take a longer view makes more sense. In the cost of debt, yeah, you can take the shorter view. That sort of makes sense. So in a few slides, we'll talk about cost of debt, but in cost of equity, again, sort of that longer rate makes sense to me, yeah? Yep, yep. It's a good question. So for those listening, question from the lady is, why don't we use the global market, right? Why don't we use a global rate for the interest rate? The reason why is, while not all the debt, if you read the JB Hi-Fi report, while not all the debt is received from an Australian bank, I think most of it is. And then some of it, I think, is from Hong Kong, and they use a swap to hedge the risk, the foreign currency translation risk. Most of it's a solid question, it's a valid question. What you do as an analyst, you see where most of the debt comes from. And if it comes from Australia, which in JB Hi-Fi's case it does, use the Australian risk-free rate. If the company does most of its borrowing in Japan, which used to be a common thing, right, because the Japanese have a very low interest rate. It was called the carry trade. So you go as a company, you're an Australian company, you don't borrow in Australia because interest rates here are 7%. You go to Japan, you create a small office, you incorporate it as a company, and you go to a Japanese bank and borrow money at 2%, right? If a company did that, yes, that sort of makes sense, that you would take an interest rate of wherever the company does most of its borrowing, and if it does most of its borrowing on the international debt markets, then you would do that, so that's correct. But if most of the borrowing comes from an Australian bank, you take the Australian point of view. Yeah, so it's a good question. Yeah, it's a very solid question. But with JB Hi-Fi, not all of its debt is Australian. That's true. I think they borrowed some money overseas and they use a currency swap contract to hedge the FX risk of the interest payments being done. I think it's denominated in Hong Kong dollar or Singaporean dollar, one or the other. I don't remember exactly. But most of it is Australian, so taking the Australian point of view sort of makes sense. But if you had data on what proportion was borrowed in Singapore or Hong Kong, what proportion was borrowed in Australia, you can actually blend the two numbers and get a value-weighted overall rate. Yep, you could do that. Sure. But not really the case in JB Hi-Fi. What else do we have here? So all the interest rates, because all the cash flows, like I said here, are nominal. Make sure you get the nominal rate. Please don't make this silly mistake. Because here, this is the real rate, right? So the Reserve Bank of Australia also has TIPS, Treasury Inflation Protected Securities. In Australia, they're just called index bonds, but in the US, they're called TIPS. The Federal Reserve in the US issued quite a bit of TIPS. I think AOFM only a few. So we can go on the website here. AOFM, I think they have a few that they've issued, obviously, otherwise you wouldn't have a rate. Ooh, ugly website. Refresh, that's better. They have a few index bonds, 35 bill. That's not small. 35 billion is not a small number. It's small relative to the overall. So most of them are real. Most of them are nominal, sorry. So they have a few tips, so you can get a tip rate, and the tip rate is 0.91, I think it was. But again, all our cash flows are nominal, so just use the nominal rate. That's a mistake if you use 0.81. Do not use the tips. If all your forecasting was in real terms, then you would use the tip as your risk-free. Otherwise, no, that's incorrect. That would be automatic deduction from me when I mark your assignment. So the risk-free rate, point of the slide is use the 10-year, use the current rate on a government 10-year, the yield on a 10-year, the nominal yield on a 10-year government bond as the risk-free. Next, the ERP. The ERP I give to you, 6%. I calculated for you. Analysts sort of, they don't fight, but there's a lot of disagreement about how the equity risk premium should be estimated. The three most popular methods are just the historical approach, and I gave you how I came up with this slide, by the way. This is not examinable, but for those who are interested, these numbers are not made up. They come from this document here that is available on Waddle, ERP estimates. 7%. No, that's, is that, do I need to update the slide? No, that's incorrect. So it's dynamic, so it updates. I'm pretty sure 6% when I'll update. I'm pretty sure I had 6%. I did this, as you can see, not yesterday. I did this in June when the index was a little bit different. It's gone up a bit since then. So I'll double check this, but use 6%. The slide is correct. And I'll update this file. I probably updated, didn't save it or something like that. So it says 7 here. But again, historical hovers between 5 and 7%. So, 5, 7, 6, it also makes sense. How I came up with these numbers is not examinable. I won't ask for it. But if you want, these are all dynamic, so you can see how I came up with it. Historical, the historical, and by historical, I mean really historical, 1800s to 2012. There is, you can have arithmetic, geometric returns. Probably because we have continuous compounding, the geometric returns probably makes more sense. So that's why I use geometric. But you can look at the arithmetic as well if you want. All the historical, going back to a long time ago, 1900s. So feel free. I don't have the time now, but feel free to have a look at this document. You can ask me about it. But what I did was I took the all ordinaries. I took the equity index, calculated the return on that index, subtracted the 10-year, the yield on the 10-year bond to get the premium, to get the premium ERP. That's the ERP. ERP is the return of the market minus the risk-free rate is the equity risk premium, and I compounded it because we have compounded returns, and you get about 6%. You can look at all the formulas here. It's all dynamic, but not examinable. Not examinable. So historically, it's about 6%. Again, hovers between 5 and 7. 6 is the long-term average. You don't have to use a historical average. It's not very sophisticated. I agree with you. It's not the most sophisticated method I've ever seen. You can use regression. With historical data, because you have a lot of data, 100 years worth of data, maybe even 130 years worth of data, regressions make sense when you have that much data. You need some variables that drive the ERP, such as dividend yield has been reported, that drives ERP. The higher the dividend yield, the higher the ERP. You have to nominate some factors on the right-hand side of the regression equation. But with a lot of data, you can run regressions if you want. If you run I've seen analysts do that. That's also one common method I've seen done. Just run a regression. The other one, which I probably like the most, it's not the best, but I can't find a better one, is an implied approach. So actually use a model of some kind. So the model I have here is very simple. In practice, I would probably use a more complicated one, but it's based on the DDM, the dividend discount model. Just discounting dividends to time 0. So this is how it works. I don't have time to do this really. Okay, quickly. I have some kind of a inflation plus real growth forecast. I have the current price, that's the left-hand side of the DDM. Remember, DDM is just price equal to dividend divided by R minus G. Remember that equation? Perpetuity, that's all it is, with growth. So on the left-hand side, I've got the index. On the right-hand side, in the numerator, I have the dividend and the next dividend growing at some constant rate, which is equal to just inflation plus real growth of the economy. And that will give me, so I have the P, I have the D, I have the G, and one equation, one unknown, I get to solve for the RE, if you like. And the RE was about 7%. Right? Well, it's 9, but then I have to subtract the risk-free rate. Yeah. So that's how I did it. But you can make a more complicated model. You can have changing dividends, blah, blah, blah. But there is a model behind it. So I like that more than a regression, which the problem with the regressions is it's only as good as the independent variables that you have on the right-hand side. And the historical average, well, it's just the average. It's backward-looking, right? So that's the problem with that. This is forward-looking. It has an estimate for dividends, which are quite sticky. Dividends tend to be quite stable over time. I mean, they do change, of course, but overall, they are pretty sticky. They don't, long-term average, they don't change that much, other than for inflation and real growth, which is why I put in, that's how I estimated the G. Yeah, but it's just one model, but it is forward-looking, which is why I like it. Again, not examinable. I don't have time to talk about it, but I'll take a look at the file and upload it, and you can ask me questions on it. So again, I sort of prefer the implied. Historical is historical. Wow, I'm so smart. It's backward-looking. That's the problem with it. Yeah. And in the past, equities did much better than they do now. Equities have sort of, in the past, 12% return, 15% return, very good returns. Now, if you have sort of 5, 6, 7% return on equity, on shares, that's considered good, right? So if you use data all the way back to 1800s or 1900s, you'll have some years that grow 20%, 10%, 15%, because that's how equities grew back then. They were considered extremely risky, right? Extremely risky, right? But sort of that idea went away, and they became more and more normal. Right, so less fluctuations, less risk, less return. Yeah. And I like, again, so my preferred method, regressions are okay, but again, only good as the variables you have on the right-hand side. My preferred method is always something implied, something forward-looking. Historically, the ERP has been between sort of that, as I said, it has gone down as low as sort of 4%. That 3 was 3.9, so it shouldn't be 3, it should be 4. I'll change the slide. And has gone up as 8. I've seen it 8, high 8s as well. But sort of around that sort of number makes sense. And the implied method does give you that. As investors, however, become more risk averse and back away from equities, the ERP does go up. And so you also, it's not just historical or in some implied model, you also have to take the perspective of the investor and say, is it risky to buy stocks now? Right? You have to ask yourself that question, because if it is, the ERP should be higher. If it's safe to buy stocks, the ERP should go down, should be lower than some 7%, right? Should be. And currently, look, it's my biased point of view, but I think stocks now are risky to buy. I think they're overbought. I think they're too expensive. That's my point of view. I'm not telling you what to do with your money. I think I can't. But I think stocks now are due for correction. Right? I think they've since the financial crisis, nothing has changed. No reform, no structural reform. The only thing that happened is money has become cheap. Interest rates went down. That's the only thing that happened. And there's no structural reform or anything like that. So stocks went through the roof. From 2012 to now, they've gone up a lot. And I think when they're becoming too expensive. And we'll talk about P ratios in week whatever, 6, 7. And then you'll get a sense, oh, that's what he means by expensive. But, yeah. But I told you 6%, so please use 6%. Nice and easy, right? When I tell you what it is, it's nice and easy. But again, in reality, you're not told what it is. You have to estimate it somehow. And as I said, you can have a regression, you can have historical data, you can have a model. You need something. You need something as an analyst. Yeah. What do we got here? Oh, the implied ERP. This is just a slide. On this slide, what I wanted to show you is, as it says here in the notes, the chart is trying to show that the implied ERP is correlated with the economy. And that means that when the economy is volatile and therefore more risky, investors need higher compensation to invest in equity, so the ERP will be higher. That's, like I said a minute ago, you can't just look at the historical average and say, oh, 6%. Or use a dividend discount model, say, oh, that Joseph likes, oh, it's 7%, use 7%. You also have to take the point of view of an investor, if you're an analyst, and say, is 7% right? If I was the investor, if I put myself in the shoes of the investor, and I looked at the stock market, are the stocks risky? Are they overpriced? In my opinion, they are. So I would expect a higher ERP, something like 6, like 7%. Less than, but again, that's subjective. That's my biased point of view. You might think, oh, stocks are cheap, buy. You can. It's your money. You can do whatever you like. But my opinion is, and we'll talk about PE ratios, the PE ratios are starting to get very high. PE ratio is essentially the price per dollar of earnings. And it's almost at 20, which means for every dollar of earnings you buy from that a company generates, you pay $20. Historically, if it goes about 13, 14, I consider that high. 18, 19, 20 is very high, right? So, but P ratio is something that's still a couple of lectures away. The point is, when the economy is volatile and risky, and we have a financial crisis or whatever it is, the ERP goes up. The ERP really goes up. Okay, so that's the ERP. So we have the ERP, we have the risk-free. Now let's talk about the beta. Beta can be estimated using regression analysis. There are two standard approaches to what you should use. I don't agree with these, to be honest. I'm not a big fan of these, but everybody uses it, and I'm like, yeah, all right, whatever, I guess, whatever, right? So the standard to estimate beta is using regression. And when you have weekly returns, use 104 observations. I think that's incorrect. I think that should be higher, but that's the standard. And when you use monthly returns, you should use 60. So 2 years of data or 5 years of data. Right? And beta, as an analyst, you have to be able to estimate yourself. Yes, you can look it up. You can look up the beta. It's not that difficult. I think I showed you that in the first lecture. Right? You can go to some kind of a data provider, Bloomberg, for example. We have Bloomberg in the school, data stream, or go through the library website, look at that analysis. Where is it? It gives you data on Australian companies, JBH, there it is. Search. Click on, I think it's key. Where's the key ones? Key data. Beta for the company is 0.95. How easy was that? Yeah. 10 seconds. I don't like that. Again, I don't trust anyone. I always like to do stuff myself. I don't know who estimated that. I don't. So it's nice to have a look at what others have gotten estimating beta for the company, but you have to be able to do it yourself as an analyst. Right? You have to. So let's have a look. So for this, I have an example for you. What do we got? Lecture notes, week 4. Here we go, beta estimation example. Let's go. So as an analyst, you get data from DataStream, for example. That's where I got your data for the assignment. So this file that's available on Waddle, I got this from DataStream. When you get the data, it looks like this. You get a big list for JBH, Harvey Norman, Meyer, TGA, Dixon's, Cons, Amazon, Best Buy, a lot of companies, not just JB Hi-Fi. Also comparable companies, competitors, right, that operate the same business model. And then the index, the market portfolio, either the 200 or the World MISCI index, right? So you get the data like this. This is index data. You need returns. Beta is calculated using returns. These are not returns. The RI means return index. It doesn't mean the return. So step 1, this example is for ABC, is to take this data and calculate returns. I use continuous returns. In the workshop next week, I'll explain why you should be using continuous returns for everything. I don't have the time for that now. That's next week's workshop. But first step is to calculate returns for your index. You can use an industry index. I couldn't find any industry index for retailing. Maybe I did, actually. I remember there was something. So I gave you, where's the data I gave you? I gave you this data. I gave you company data. No, I couldn't find any index. No. You're lucky. Yeah. So where's my example? Here. So in this case, this was for ABC. Adelaide Brighton was the company we're valuing, but you don't have to estimate beta just for your company you value. You can estimate beta for the comparable companies as well, because they operate the same in the same industry, which means they have the same risk. They should have a similar beta. All right? So you can estimate the beta for not just your company, but also Harvey Norman, Dixon's, Best Buy, all the companies I gave you data for. First step, once you have the returns calculated, so first step is to calculate the returns, like the example says here. Next step, check for outliers. Outliers, remember, beta estimation, if you like regression, is just the slope. Let's do it this way. The regression is just you've got data points, and a regression, all it does is it fits the line of best fit that minimizes the sum of squared errors. That's all it does. If you have some rogue observation here, an outlier, it will push even one observation. Remember, the model doesn't care. It takes this as any data point. It treats every data point the same. All it cares about is minimizing this distance. So because of that one observation, it might actually shift the line from here to something like this, because the line here is just so much smaller, and this is sum of squared errors. It's a square. It's not just the distance. It's the distance squared. So a large number squared is an extremely large number. So it just wants to minimize it. So what we should do is check for outliers to make sure that these values do not reduce the slope, because the slope is the beta. The slope of this regression line is the beta. Right? So your job is to, as an analyst, is when you have the returns of your market portfolio, in this case the 300, and your company, is to do a scatter plot. Do a scatter plot and check for outliers. That's obviously an outlier. This, if I didn't delete this observation, it would push the slope up to maybe something like this. Instead of beta being 0.9, it would be 1.1. And that makes a big difference in the WACC. You'll be surprised. So when you do so what you're looking for with an outlier is these sort of points on the very fringes. You've got most of the observations here, all the action is here, and then you've got these rogue observations. So that's an outlier. That looks like a rogue observation as well, right? It's actually not. It's the return is, where is it? Did I mark it? I didn't mark it. So it's here somewhere. Look for a large negative number. There it is. As you can see, that's for 2008. Right? So bad time to be an investor in late 2008 because we had the financial crisis. Right? So that looks like an outlier. It's not. It's just bad week. These are weekly returns. Bad week to be an investor. You lost 18% of your market portfolio and 22% of your value if you were a Adelaide Brighton shareholder. Ouch. Ouch. Not good. You were not happy that week. Right? So it looks like an outlier, but it's not. It's just a bad week to be an investor. So generally with an outlier, when the difference between the x and the y coordinate is sort of more than 20, 25, it's generally an outlier. Anything, if the difference is 10%, it's fine. 15% subjective, probably not. If it's above 20, 25, it's generally outlier. Again, there's no rules. There's no rules. It's just what I did when I was an analyst. But see, the difference here is it's 28%. So return on the market was 0.63% per week, and for ABC it was 28%. So that's a big difference. That's 28%, 27% difference. That's an outlier. You want to delete that. So once you have all your returns and you identify your outliers, you then delete them. Yeah, you delete the outliers, as I say here. So see, this is deleted. So these outliers, you can see, this outlier is deleted. Do I have another one? No, I just deleted that one. Right? And then you're ready to run your regression once you have the outliers deleted. You don't have to delete them. You can Winsorize them. You don't have to, there's two approaches, trim or Winsorize. Trim means delete. You don't have to do that. You can Winsorize, but in this course, it doesn't really matter. Okay. So once you have that, you're ready to run your regression. You're ready to run your regression. What you do there is you can have, what do we got here? We've got two ways you can do this. Let's do the stupid way first. Files, it's not up, where is it? Yeah, it's here. Add-ins, go. The analyst tool pack is what you're looking for, okay. That will give you the data analysis package, and here it has regression as one of the functions that it can do for you in Excel. It doesn't have to, you don't have to do that, but that's one way to do it. Once you have that, then you've got your Y coordinate. Your Y coordinate is the returns of the company that you're after. So that's all these minus the outlier. Your X range is the return of your market portfolio. It's the MISCI or the ASX 200, 300, whatever you want to use. You want the output range usually in the same sheet. Let's put it here. Voila. Okay. That's correct. That's correct. That looks correct to me. It probably doesn't like the gap. Yeah, it probably doesn't like the gap. We can get rid of it. Yep. Let's try it again. What do we got here? So data analysis, regression, yes. That's just, let's try again. Let's just do this. All of that. And that's the same, just that one number. Yep. Didn't like the 0. And voila. And the, what is that? Oh, that's, oh, I used all the observations. So this is, yeah, see, I was implicitly biased. See, I like using a lot of data in regressions. This is weekly returns. I'm supposed to be using 104 observations according to the rules. I just use all the data. And my beta is 1.04. To me, that makes more sense. The textbook will tell you to an analyst, and I've seen analysts do this, to use, when you use weekly returns, this example is weekly returns, 104 observations. So what you have to do is count 104 observations, which marked by the X, 104, no, it's not. Where did I do it? Here? Yeah. 104 observations, including that one deletion, so X should be here actually. And now, let's repeat it again, third time's the charm. What do we got here? So, analysis regression, boop, 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 boop. So the Y coordinate is the returns of your company, these ones. And your X coordinate is the returns of the market portfolio. And let's put it in, let's put it down here. Yeah, you got 1.09. So something similar, but not the same. And that's the example here. Look, follow the rules. I'm all for the rules and everything. To me, it makes more sense that not to use more data. The reason why your textbooks will tell you not to use all the data is because companies can change. And I get that. But JB Hi-Fi as a company has not changed in a while. They're still opening new stores. Their business model has not changed. They're an Australian-based company opening stores in key locations that have high foot traffic. And when a company doesn't change, they don't suddenly turn into a phone company or a computer company, it makes sense to use more data. But if you use 104, you get a beta of, it's the X coordinate here, is the slope, the M. 1.09. Now, that's the stupid way of doing it in Excel. There's a smarter way to do it using the slope function. The syntax of the code is equals slope, first the returns of the company, and then the returns of the index of the market portfolio. So it's there as an example. That's the syntax, and you'll get the same number, by the way, exactly the same. Because you have historical data, you have a lot of historical data, and if you use all of it, again, you get a beta of 1.04, which is exactly the same as what I did when I used all the observations. You can do something more sophisticated than just using one regression model, one regression estimation. You can do what we call a rolling beta analysis. That is, you use the slope function, you always have 104 observations, weekly observations, and you just keep adding. For each week, you keep adding one observation and taking one observation from the top, the oldest data. So it's a rolling estimate of 104 observations through time. That's called the rolling beta. It's right here. It's still the slope function, and you're just taking one observation and reducing one from the top. If there is a deletion because of an outlier, you should still have 104 observations. So if you delete one number, it becomes 103. Add another number, so it's always 104. You can do that through time and then plot and see how the beta changes and see how it's changed. And you can see that, and that the benefit of that is you can see how stable the beta is. What I see here is it was quite unstable here and companies growing and doing crazy things. And then over here it's sort of stabilized. So if I want to use more observations than 104, I would sort of take this point or maybe this point or this point and then use all the data from that point. Once the riskiness of the company is sort of stabilized. Remember, beta is just a proxy for risk. And you can also do basic diagnostics, min, max, median, mode. You can do whatever you like. And take the median or the mean, if you like, the average beta of the roll of all these betas that you have through time. The example's here for you. And so use the slope function. Don't use this method. Don't use that. Don't use this. I think it's annoying. You get the same number, and you have to click. You get errors like I showed you. The slope function is a lot more flexible. So my recommendation is to use that. So then that's step 4 to calculate the beta. Step 5 is you do all these calculations, not just for ABC in this example, or JB Hi-Fi for you, but for the other comparable companies as well. I gave you the data, right? So do it for that. Repeat the entire analysis that I just showed you using monthly returns. These are weekly returns in this example. Any further analysis, I'll talk about that in the workshop next week. There's more analysis that you can do. You can estimate your beta in over multiple periods, not just using one approach. And then you do all that, you get so many betas, min, max, median, mode, average, JB Hi-Fi, Harvey Norman, Best Buy, all these different companies. You have to make a selection. It could be like an average of the average, and that number goes in here as your beta for JB Hi-Fi. I just talked about this. I've got 2 more minutes. That's all I need. So I talked about this. By doing a rolling beta, you can see how stable it is. And JB Hi-Fi has been a stable company. Their business model hasn't changed. So using more than 104 weekly or 60 monthly observations makes sense to me. But do what the textbook way, and then you can do an additional way using more data. Yeah. You have to always check for outliers. You have to check. You should calculate betas for comparable companies because they have the same business model as JB Hi-Fi. They have therefore the same risk. They're in the same industry, so they should have a similar beta. So it sort of gives you a range. The comparable companies give you a range of what makes sense. And then, of course, do the weekly, do the monthly. Don't do daily. I didn't give you the daily data anyway. I've seen some analysts do daily. Daily is too granular. It's too volatile. This is the more stuff I've been talking about that you can do. I'll talk about that in the workshop next week. This is the rolling beta. Remember the syntax. Don't make this mistake. The syntax is slope in Excel, returns of the company first, not the returns of the market, not the ASX 200 or the MSCI. It's the returns of the company, JB Hi-Fi, Harvey Norman, whatever it is, and then the returns of the market. And for you, this is either the ASX 200 or the MSCI. And then you can plot your rolling betas to see how stable they are. And I'm out of time. I'll finish in the workshop. Thank you. Yeah, go ahead.
So, firstly, the regression. Why don't we use the exact return or just use the normal return? I mean, from the formula.
Yeah. Why do we use the continuous return?
I mean, it's the excess return, the real return